Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Gary McDaniel, Senior Managing Director with Guggenheim Partners, to discuss a recently launched dividend portfolio, which employs a unit investment trust strategy. So we'll learn more about what UITs are as well. Gary, welcome to Trade Talks. It's great to have you with us.
Jill, it's great to be with you. Thank you.
Guggenheim recently launched a blue chip dividend portfolio. Tell us about this strategy.
That's right, Jill. We really wanted to build off of the strength of our blue chip growth product, which has become one of our flagship products. And we thought in this environment, it made sense to provide our clients with access to very high quality industry leaders that are paying above average dividends and which are presenting lower fundamental and market risk than the market as a whole. Additionally, we really think blue chips are attractive for clients in this environment because they are recognized market leaders. They're financially sound companies with very strong management teams and robust capital structures. And that gives them the resources and the ability to invest in their businesses to really adapt and thrive amidst the pandemic and post-pandemic realities. One of the things we think is unique about this strategy is we're only investing in industry leaders, as I said. We limit ourselves to the 200 largest companies in the US marketplace. And one of the interesting things about that is they provide an inherent buffer against market volatility. If we look at performance over the last year, the 200 largest stocks have delivered 102% of the upside in periods where the market has risen versus just 93% of the downside when markets have declined. And that's really one of our focuses at Guggenheim, is delivering those asymmetric risk return opportunities to our clients.
What types of characteristics do you look at for stocks inclusion in the portfolio?
Well, there's three primary things that we look at. As I said, we start with the 200 largest US listed companies. We then look for companies that are paying a dividend yield, which is in excess of the average for their industry. And then the third primary screen is to look for companies where cash from operations exceeds that dividend payment. We want to limit ourselves to companies that are actually earning their dividends that they're paying out. Once we've satisfied those first three screens, we really look next for sustainable competitive advantages. This is also something called an economic moat. And it might be sourced from something like a proprietary technology, a brand strength, a built-in cost advantage, just having a better management team than your competitors. And what that economic moat delivers is the ability to earn higher returns on capital, to produce better growth in revenues and profitability than your competitors, and more stable share prices, particularly during times of market volatility. And then the last thing that we look for are companies that are really managing their risks well and that are setting themselves up for upside opportunities. So we look through recent news and company filings to really identify those companies that we think are best positioning themselves for success today.
Why would this type of strategy be appealing in today's environment?
When we looked at the market this spring and we looked at the way that we're responding to the coronavirus pandemic and to the facts on the ground, we see an ultra low interest rate environment extending for many years in the future. And we think in that environment, investors are going to need to source income from new ways, and they're going to need sustainable income. And so we really believe that high quality companies that are paying attractive income and that are earning that income are likely to see their multiples expand in this environment. Additionally, again, in a pandemic and post-pandemic environment, large companies that are leaders in their industry will have the resources, they'll have the diverse skill sets among their staffs, they'll have the scale and access to capital markets that are going to be needed to invest in businesses, to change the way that you're doing business, to provide PPE to your staff as needed, to make the adjustments to offices to enable people to come back into the workforce. So that's another reason we really think investing in those leaders and those largest companies makes a lot of sense. Because ultimately, we do believe at Guggenheim, we're on the road to recovery. The economy is strengthening. We're dealing with the health crisis, but that road is going to be bumpy. And we feel that we need to provide a defensive portfolio to our clients, and that mega caps really will bring us that level of defense that we need today.
So Gary, what types of stocks might be found in this strategy then?
Oh, Jill, these are some of the world's leading companies. It's really a who's who of corporate America. In addition to that, these are companies that are paying above average dividends, dividends that they're earning, dividends that they're actually sourcing out of their cash flows. And you're going to find the portfolio is concentrated. It's going to be concentrated in companies with superior growth opportunities, both from a revenue standpoint as well as a profitability standpoint. Concentrated in companies with very effective management teams that are addressing downside risks and really positioning themselves well, and companies that are trading at attractive relative valuations relative to their competitors. So you'll see consumer names like Johnson & Johnson and Procter & Gamble, McDonald's, Coca-Cola, industrial names like General Dynamics or Honeywell, DuPont, Texas Instruments, Union Pacific. Again, all names that resonate with people, that are clear leaders in their field, and again, where we feel they've addressed downside risks and positioned themselves for upside opportunities.
So the portfolio strategy is a unit investment trust, or what we call UIT. For the benefit of the audience, explain what a UIT is and how it might benefit an investor.
That's interesting. UITs are one of the oldest investment products around. They've been around for over 100 years, but they remain a very popular choice today for advisors that are seeking a focused, transparent way to solve problems for clients and to deliver really a customized solution and customized portfolio. Similar to ETFs or mutual funds, these are professionally selected portfolios that deliver specific outcomes to clients, but in a lot of ways, they're very different from mutual funds and from ETFs. For one, they're 100% transparent 100% of the time. The day we deposit a UIT, our clients know exactly what we're going to own in the portfolio and in what ratios, and that's not going to change through time. Second, they mature after a specified period of time, typically 15 or 24 months, although occasionally there are other maturities that are available. The great thing about that is it forces clients to, one, dollar cost average because you're using those portfolios through time. Two, you're constantly being forced to reassess your portfolio allocations. Each time you have a product mature, you have to decide, do I still think that it makes sense to be in mega cap stocks or in different asset classes? And we really think that's a benefit to investors. And then the third difference is that while UITs themselves have daily liquidity, the portfolios that we invest in really reflect a buy and hold approach, where again, we tell you on day one what you're going to own throughout the life of that trust.
And to wrap up here, how would an advisor learn more about Guggenheim's blue chip dividend portfolio?
One way is to call our sales desk. They'd be happy to talk to you about it there. Our sales desk is at 1-800-345-7599. Of course, GuggenheimInvestments.com has a wealth of information that we invite advisors to review. And your site, Nasdaq's UITinvesting.com, has a wealth of resources on blue chip dividend and on Guggenheim UITs in general, as well as UITs from other sponsors.
All right, Gary, thanks so much for joining us on Trade Talks.
Jill, thanks again for having me here. Have a wonderful day.
Thanks, you too. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.